Recoupment of overpayments of salary by an employer from an employee. This video guide sets out the legislative framework and revenue's position regarding the recoupment of an overpayment of emoluments by an employer from an employee. This video guide covers the general position, the current year overpayment recoupment from a current employee, the current year overpayment recoupment for a former employee, the out of year recoupment from a current employee, and the out of year recoupment for a former employee. The recoupment spanning a number of years. An employee making a claim for a repayment of tax and USC. The process for making a claim. The statutory time limit for making a claim. PRSI refunds and repayment of emoluments following the death of an employee. The general position. Any recoupment of an overpayment of emoluments paid to an employee must be recovered on a gross pay basis, that is, before any deductions such as income tax, universal social charge and pay-related social insurance. Much of the detail in this video guide is information provided courtesy of the Revenue Commissioners under a Creative Commons Attribution 4.0 International, that's CC by 4.0 license. Just so you know, my name is Boyle, Payroll Specialist at Boyle Payroll Project Management, Ireland's premier payroll providers for small business and first choice tax agents for PAYE workers to claim tax credits and complete their income tax returns, and many more services. www.bppm.ie is the website. Please feel free to contact us using the contact tab on this website address, or follow our community Facebook page, Boyle Payroll Project Management, for payroll, press releases, income tax and other PAYE and revenue updates, or subscribe to our channel, Payroll Matters in Ireland, if you have not already done so. Permitted deductions from wages. Some deductions from wages are allowed by law, for example PRSI, income tax and universal social charge, etc. As a general rule, however, no deductions from wages are allowed without the written permission of the employee in advance of the deduction being made. However, the Payment of Wages Act 1991 does not apply to the overpayment of wages to the employee by the employer. The employer is entitled to deduct any overpayments of wages, but nothing in excess of the actual amount overpaid. As tax agents, as well as our main business of processing payroll for small businesses and completing income tax returns for PAYE workers, we at Boyle Payroll Project Management BPPM also administer the very popular Facebook group for PAYE workers to ask and get answers to a wide range of payroll, income tax, PAYE and many more work-related questions. The name of the group is Payroll Matters in Ireland, and new members are always welcome. Questions regularly crop up about employers' entitlements to deduct overpayments from employees. While many employers have policies surrounding the process for the recoupment of overpayments, and while it is good practice for employers to have such policies, they are not obliged to provide such a policy under the Payment of Wages Act 1991. Section 2.2, Current Year Overpayment Recoupment from a Current Employee. Where the overpayment is being recouped by means of a deduction from emoluments in the current year, the gross amount of the overpayment is deducted from the gross emoluments using this method, any tax rebate due to the employee will be generated and paid to the employee through the payroll. Pension, additional superannuation contributions, ASC, USC and PRSI contributions should also be adjusted accordingly where appropriate. Example 1. In May 2025, it was discovered that Adam had been placed on the wrong pay scale after the award of an increment in March. This had resulted in Adam being overpaid for 12 weeks with a total gross overpayment of €360. As the overpayment was discovered in the year in which it was made, it has been agreed between Adam and his employer that he would repay the overpayment in 2025 over a 12-week period. Therefore, the gross amount overpaid to Adam is recouped by deducting €360 from his gross pay over 12 weeks. That is €30 per week. See the table here. As Adam paid income tax, universal social charge and pay-related social insurance on the overpayment of €360, any refund for this will also be made by the employer through payroll. PRSI rates in the example throughout this video guide are applicable from the 1st of October 2024. The Department of Social Protection, the DSP, provides details of each PRSI class and the PRSI contribution rates. Please be aware that the overpayments referred to in this video guide all happened in 2025, so the time limit used in this video guide will be different from the time limit that will be applied for overpayments in 2026. So, just to set the record straight, revenue must apply the statutory 4-year time limit for making a claim for repayments of tax. For example, in 2026, a repayment of tax can only be made for the years 2022 to 2025. Claims for 2021 and prior years are now out of time and cannot be processed by revenue. Table 2 here is an extract from a payroll submission before the discovery of the overpayment. Table 3 is the extract from a payroll submission following the discovery of the overpayment. Section 2.3. Current year overpayment recoupment from a former employee. When an employee leaves employment in the current year and is required to repay an overpayment of salary, the former employee may repay the value of the overpayment net of tax to the employer. Example 2. Anya left her employment with an employment ID of 1 on the 14th of March 2025. And following the final payroll submission for March, Anya's former employer discovered that she was paid gross holiday pay of €450 in her final pay in March 2025, to which she was not entitled. As the overpayment is discovered in the year in which it was made, Anya can repay the net overpayment to her former employer in the current year. Anya agrees with her former employer that she will repay the net overpayment of €412.93 in one repayment in April 2025. For illustrative purposes, tax at the standard rate applies in the example here. Upon receipt of the full net repayment amount of €412.93 in April 2025, Anya's former employer can report a negative gross payroll figure of €450 in the April payroll submission, with consequential negative deductions for income tax, USC and PRSI. To see this here in Table 4. The negative payroll submission should include the same employment ID as when Anya was employed by her former employer, the cessation date of the employment and the payment date when the overpayment was repaid to the former employer. This negative payroll submission is done without requesting an RPN or a revenue payroll notification. Our former employer should not amend or delete the original payroll submission made in March 2025. When the former employer reports the negative figures in the April payroll submission to revenue, Anya's employment record will be updated accordingly. This Table 4 here is the extract from a payroll submission following the recoupment of the overpayment in April 2025. 2.4. Out of year recoupment from a current employee, where the overpayment is being recouped by means of a deduction from emoluments paid to the employee in a later year. The gross amount of the overpayment is deducted from the net pay. Where an overpayment has been recouped out of year, the employer should issue a statement to the employee setting out the year to which the overpayment relates and to the year and amount of the overpayment recouped. Example 3. In 2024, Megan was overpaid by a total of €1,200. This was discovered in March 2025. An instalment arrangement to recoup the overpayment was agreed between Megan and her employer. She will repay €40 per week for the remainder of the year 2025 and thereafter until the total overpayment has been repaid. As the overpayment occurred in a previous year, the out-of-year recoupment method must be used. That is, the gross overpayment must be collected from her net pay in the current year. Here is how it looks on this table. On completion of the recoupment plan and on receipt of the statement from her employer, Megan can apply to revenue for a refund of any income tax and universal social charge that has been deducted on the €1,200 overpayment. We will deal later with making a claim for a repayment of tax and universal social charge in Section 4. Megan can apply to the DSP or the Department of Social Protection for a repayment of the employee's PRSI paid on the overpayment in 2024. Information on how to apply for a refund of PRSI can be found on the DSP's website. Here is the link here. The recoupment of the gross amount of the overpayment from net pay should not be reported to revenue on a payroll submission. By recouping the gross amount from the employee, the employer has recouped an amount that includes both the net pay and any payroll taxes operated on the net pay. This Table 5 here is the extract from a payroll submission following recoupment, demonstrating that the gross amount recouped is not reported to revenue. 2.5. Out-of-year recoupment from a former employee. Where an individual has ceased employment in a previous year and is required to repay an overpayment of salary, the former employee must repay the gross amount of the current overpayment directly to the former employer. The procedure for claiming any refund of income tax and universal social charge that may be due on the overpayment that has been repaid by the former employee is the same as set out in Section 2.4. 3. Recoupment spanning a number of years. Where a recoupment of an overpayment spans a number of years and recoupment can commence in the year in which the overpayment occurs, the current year recoupment method as set out above in Section 2.2 should be followed. Recoupment of an overpayment or part of an overpayment in subsequent years must use the out-of-year recoupment method as set out in Section 2.4. Example 4. In 2024, Mark was overpaid by a total of €2,800. This overpayment was discovered in November 2024. An instalment arrangement to recoup the overpayment was agreed between Mark and his employer. Mark agreed he will repay €200 per month, so the total overpayment will be repaid by his employer over 14 months. The repayments commenced in December 2024 and will conclude 14 months later in January 2026. As the first instalment is in the same tax year in which the overpayment occurred, that is 2024, the first repayment of €200 is recouped by deducting €200 from Mark's gross pay in December 2024. This is the table of Mark's monthly pay calculations in 2024. As Mark paid income tax, universal social charge and pay-related social insurance on the overpayment of €200 in 2024, any refund for this will also be made by the employer through the December payroll. Table 7 is an extract from a payroll submission in 2024 before the discovery of the overpayment. Table 8 is the extract from the December 2024 payroll submission following the discovery of the overpayment and the first repayment. From January 2025, as the overpayment occurred in a previous year, the out-of-year recoupment method must be used. That is, the gross overpayment must be collected from Mark's net pay in the current year of the repayments, that is 2025 and 2026. Here is the breakdown. On completion of the recoupment plan in January 2026 and on receipt of the statement from his employer, Mark can apply to revenue for a refund of any income tax and universal social charge that has been deducted on the overpayment of €2,600. That is the total overpayment of €2,800 less the first repayment of €200, which was repaid in the same tax year in which the overpayment originally occurred, as this amount was corrected in the December 2024 payroll, recouped in 2025 and 2026. Here again, see Section 4 for making a claim for repayment of tax and universal social charge. Mark can apply to the DSP for a repayment of the employee's PRSI paid on the overpayment amount. Information on how to apply for a refund again of this PRSI can be found on the DSP website, and here again is the link. The recoupment of the gross amount of the overpayment from net pay in 2025 and 2026 should not be reported to revenue on any payroll submission. By recouping the gross amount from the employee, the employer has recouped an amount that includes both the net pay and any payroll taxes originally applied on the overpayment. This table 9 here is the extract from a payroll submission following recoupment, demonstrating that the gross amount recouped is not reported to revenue. 4. An employee making a claim for a repayment of tax and universal social charge. Section 4.1, the process of making a claim. A claim to a revenue for a repayment of income tax and universal social charge can only be made where the recoupment refers to prior year overpayments. Income tax, universal social charge and PRSI overpayments for current year are refunded by the employer through the payroll. And again, you can see this in Section 2.2. Where an out-of-year recoupment occurs, the employee can make a claim to revenue for any repayment of income tax and universal social charge that may be due. He or she must submit their claim to revenue through My Inquiries via my account or by post with the appropriate statement from their employer setting out full details of the amount of emoluments overpaid and the time frame of recoupment of the overpayment. 4.2. Statutory time limit for making a claim. Revenue must apply the statutory 4-year time limit for making a claim for repayment of tax For example, in 2025, a repayment of tax can only be made for the years 2021 to 2024. Claims for 2020 and prior years are now out of time and cannot be processed by revenue, where the recoupment is made in full within the 4-year time limit. Revenue will process any refund that may be due to the employee. Where an employee makes a valid claim for a year, for example, a claim for year 2021 must be made by the 31st of December 2025, but the overpayment will not be totally recouped from him or her for a number of years. Revenue can make a refund at a later date, but only after the overpayment has been repaid in full to the employer. See example 5 below. It must be noted that a repayment can only be made where revenue holds a valid claim from the employee within the statutory 4-year period in respect of the relevant year. Where the recoupment extends beyond the 4-year time limit, an employee should A. Advise revenue that he or she wishes to make a claim for repayment of tax for the relevant year, for example 2021, but that the overpayment will not be fully recouped from him or her by the employer for a number of years, for example extending to 2026. B. Forward the statement from the employer as set out here in this sample. C. When the overpayment has been totally recouped by the employer, for example in 2026, the employee should then request revenue to make any repayment that may be due in respect of the relevant year, for example 2021. Further information on the statutory 4-year limit and making a valid claim is available in Tax and Duty Manual Part 37.0030 on the Revenue website. Example 5. Refund of an overpayment spanning a number of years. In March 2025, it was discovered that John has been on the wrong pay scale since 2019. This has resulted in an overpayment of emoluments to him of €7,200. We can see this here in Table 10. John and his employer came to an arrangement that he would repay this over the course of 4 years, from 2025 to 2028. Year 2025. For the remainder of 2025, the recoupment in respect of January to March, when the overpayment was discovered, 2025, is deducted from John's gross pay under the current year recoupment method outlined in section 2.2. Year 2026 and subsequent years. For the remainder of the instalment arrangement, the out-of-year recoupment method set out in section 2.4 applies. To claim a refund of the tax and USC that may be due on the overpayment, John needs to make a valid claim to revenue. Again, we can see this in section 4, making a claim for a repayment of tax or USC. Table 10, this is the overpayment to John by his employer spanning a number of years. On completion of the repayment for each individual tax year, John will be able to claim any overpaid tax back from revenue. That is, once 2021's overpayment has been recouped in full, John can claim a refund of tax for 2021. However, John will not be able to claim a refund of tax for the years 2019 and 2020, as these years were outside the 4-year limit. Please be aware that we are now in 2026 and recoupments for 2021 are now complete, and now the last year that you can get a refund of tax or USC is 2022. John will, however, be able to submit a valid claim for the subsequent years. For example, a claim for year 2021 must be made to revenue by the 31st of December 2025. And as we said, that has now passed. And the claim for year 2022 must be made by the 31st of December 2026. even though the overpayment will not be totally recouped from him for a number of years. Provided revenue hold a valid claim for the year 2021, any refunds that may be due can be made later after the overpayment has been paid back in full, for example, in or after 2028. 4.3 PRSI refunds. Any out-of-year overpayments of employee or employer PRSI is a matter for the DSP and must be claimed directly from the department using the relevant forms, which are available on the DSP website or contacting their local DSP office. 5. Payment of emoluments following the death of an employee. Where an employer continued to pay emoluments after the death of an employee, the net amount of the overpayment should be repaid to the employer by the estate or the legal person representatives of the deceased employee. Where an overpayment to an employee, including a pension member, is discovered following their death, the net amount of the overpayment should be repaid to the employer by the estate of the legal person representatives of the deceased employee. The following procedure should be applied depending on the circumstances of the overpayment. A. If the overpayment relates to a single pay period within the current year, the employer should submit a negative payroll submission of gross pay for the period in which the overpayment was made, with consequential adjustments for income tax, universal social charge and pay-related social insurance. B. If the overpayment relates to multiple pay periods within the current year, any overpayment recouped should be applied in the first instance to the most recent pay period in which an overpayment occurred. Where there is full recovery of the net amount overpaid for that period, the employer should submit a negative payroll submission of gross pay for that pay period, with consequential adjustments for income tax, universal social charge and pay-related social insurance, PRSI. A negative payroll submission should be completed for each period in which there was an overpayment. Employers should not submit one payroll submission covering multiple pay periods to report the full recoupment of the overpayment to the deceased employee. C. If the overpayment spans more than one tax year and the net recoupment is recovered from the estate, the legal person representative, the relevant payroll in which each of the overpayments occurred must be adjusted accordingly. The relevant payroll submissions are the actual payroll submissions in which the overpayments occurred. The employer should submit a negative payroll submission of gross pay for the period in which the overpayment was made, with consequential adjustments for income tax and USC. PRSI may be recouped from the Department of Social Protection. In all instances, the negative payroll submission following the recoupment of the overpayment must include the date of cessation, that is, the date of death, and the payment date. The payment date is the date on which the overpayment was repaid to the employer. The original employment ID must be used, and the employer should not request a revenue payroll notification for the deceased employee. Example 6. The following example sets out how the recovery of an overpayment made following the death of an employee should be processed. An employee died on the 31st of January 2025, and the payments for February 2025 and March 2025 continued to be made by the employer. The gross payment was €200 and the net payment was €150 each month. In April 2025, the employer received a net repayment amount of €150, which is allocated to the March 2025 payment to the deceased employee. Consequently, the employer can report a negative gross payroll amount of €200 for this employee for March 2025. This is done without requesting an RPN or a revenue payroll notification. In May 2025, the net payment for February 2025, that is €150, has been recovered in full from the deceased employee's estate. Therefore, the employer can now report a negative gross payroll amount of €200 for February 2025. As a result of each negative payroll submission, the employer's monthly statement for each relevant month will be amended to reverse the overpayments to the deceased employee. The deceased employee's pay and tax record will be amended for the year of death. Before I leave you for now, can I ask those of you that have not already done so to hit the like, follow or subscribe button depending on what platform you are watching this video guide on, as we have many more helpful pay, income tax and other work-related guides and videos to bring you. It costs you nothing to like, follow or subscribe, but could help you save hundreds or even thousands of euro into your hand on pay and tax. Go on, hit that like, follow or subscribe button. Go on, go on, go on, go on. See you next time, and thank you for watching.